Right now, you almost certainly hold life and TPD insurance, and there's a good chance you've never actually looked at it. For most people, it sits quietly inside their super fund, with premiums skimmed off the balance automatically, so it feels invisible and cheap. The alternative is buying cover outside super, paid from your own bank account, which feels like just another bill. But cheap and good aren't the same thing, and the gap between these two choices can run into hundreds of thousands of dollars at exactly the moment you'd need the money most. Let me help you settle which one actually wins for your situation and when. Here's why this matters for you. According to APRA and ASIC's 2023 claims data, the average total and permanent disability payout through a retail policy outside super is around $643,000 versus just $143,000 for the default group cover most people hold inside super. That's roughly 4.5 times more cover for the day you can no longer work. Life insurance shows the same pattern, about $509,000 outside super versus $135,000 inside. And those inside super premiums aren't free either. If you're 30 and paying $400 a year from your balance rather than your after-tax pay, you'll end up with around $26,000 less at 67, purely from loss compounding. So you can quietly be both underinsured and out of pocket at the same time. But here's the part most people miss, and it's coming up next. And if you've never chosen your cover deliberately, that's not a failure. The vast majority of people are put into a default and never told to check it. So let me show you how the two options actually work. Inside super, the trustee owns the policy. Premiums come out of your balance and cover is usually a default you never picked. ASIC Money Smart notes this is funded indirectly by contributions taxed at just 15%, which is exactly why it feels cheap. Outside super, you own the policy directly, you pick the cover amount and type, and you pay from your after-tax income. The trade is convenience and apparent cost on one side, against control, payout size and tax treatment on the other. Keep that in mind because almost every difference flows from it. Inside super is the path of least resistance, and for some people that's a genuine advantage. You typically get default life and TPD cover automatically, often without any medical questions, which is gold if you've got a pre-existing condition that might otherwise see you declined. And the tax efficiency is real. ASIC Money Smart notes premiums are effectively funded from contributions taxed at 15%, versus a marginal rate that can reach 45% plus the Medicare levy outside super. If you're young, healthy, cash-strapped and have no dependents, baseline inside super cover is a sensible, low-effort starting point. The trouble starts if you assume the default is enough, because it rarely is. The clearest case for keeping cover inside super is the funding mechanics. Your fund buys group cover in bulk, which can keep headline premiums low, and because the money comes from contributions taxed at 15% rather than pay taxed at up to 45% plus Medicare, the effective cost can be meaningfully cheaper. That's straight from ASIC Money Smart. If you're a higher earner, paying with pre-tax dollars is genuinely efficient, and nothing ever lands in your household budget, so the cover just persists. But I want to be honest with you here. That same invisibility is exactly what lets the cost and the underinsurance slide by unnoticed for decades. Hold on, because what I'm about to show you changes the whole picture. Now the catch, and it's a big one. APRA and ASIC's 2023 data show average group TPD payouts of just $143,000 versus $643,000 through retail policies, leaving you around $500,000 short if you rely on the default. Second, those invisible premiums compound away. $400 a year from a 30-year-old costs about $26,000 by 67 at a 6.5% net return. And third, when you actually claim, a TPD benefit paid through super can be a taxable super lump sum. MetLife explains that under preservation age, the taxable component can be hit by up to 22%. On a $250,000 taxable component, that's around $55,000 in tax you simply wouldn't pay outside super. Convenient, yes, but costly at exactly the moment it counts. Outside super flips the model entirely. You decide what you need and you buy exactly that, and the payouts reflect it. APRA and ASIC's 2023 data show retail life cover averaging $509,000 and TPD $643,000, multiples of the group figures. You also unlock cover types Super simply doesn't offer. Trauma or critical illness insurance is generally unavailable inside Super per ASIC Money Smart, yet it can be vital if you survive something like cancer or a heart attack. This is the option for you if you've got a mortgage, kids, or a partner depending on your income. The price of all that control is that the premiums come from your own after-tax pay. A visible, ongoing cost that takes a deliberate decision. And here's where it gets genuinely interesting. The strongest argument for going outside is what actually hits your bank account. MetLife notes that a successful TPD payout held outside super is generally not taxed, and it's paid directly to you or your nominated beneficiary. Compare that to inside super, where the insurer pays the trustee, who then has to apply super law conditions of release before any money reaches you, slower and potentially taxed. On a $300,000 in TPD benefit, outside super delivers you the full $300,000 net. Inside super, under preservation age, tax can carve out around $55,000. You can also lock in stronger own occupation definitions that are easier to claim on than the more restrictive definitions inside super. Now here's the number that actually decides this for most people. But first, the honest downside. Outside, super isn't free of downsides, and I won't pretend otherwise. The premiums land in your household budget every month, and unlike income protection, TPD and life premiums bought personally are generally not tax deductible per MetLife. There's no 15% contributions tax shortcut quietly subsidising the cost, and because you fund it from your own pocket, if you miss payments, the policy can lapse. There's no super balance silently topping it up. If your cash flow is tight, that visible cost is a real barrier, and it's precisely why so many people default to the inside super option, even when it leaves them badly underinsured. So let me give you the number that cuts through all of this. Let me score the first 4 things that matter to you. On premium funding, inside super wins. ASIC Money Smart confirms it draws on contributions taxed at just 15%. On cash flow impact, inside super wins again, because nothing touches your take-home pay. But on payout size, the picture flips hard. APRA and ASIC's 2023 data show average life payouts of around $135,000 inside super against $509,000 outside, and TPD of $143,000 against $683,000. So inside super takes the convenience rounds, while outside super takes the rounds that decide whether your family is actually protected. We're 2-all so far, and the next round is where it separates. Now the next 3, on tax, when you claim, outside super wins clearly. MetLife notes super TPD benefits can be taxed up to 22% under preservation age, while outside super payouts are generally tax-free. On how fast you get the money, outside super wins again. It pays directly to you or your beneficiary, whereas inside super, the trustee has to satisfy super law conditions of release first. And on the range of cover, outside super offers trauma or critical illness insurance that ASIC Money Smart confirms is generally unavailable inside super. Outside super sweeps these quality rounds, 3-0. But here's where most people jump to the wrong conclusion. Let me show you. Let me tally it for you. Inside super won 2 rounds, premium funding and cash flow impact, both about cost and convenience. Outside super won 5. Payout size on both life and TPD, tax at claim, speed of access, and breadth of cover. On rounds alone, outside super is the clear points winner. But here's the part most people miss. This isn't actually an either-or fight, and treating it like one is where the real mistake happens. The smart answer for most people combines both, and there's one single number that tells you exactly how to split them. Let me give it to you now. Here's the number that decides it for most people. Your age, with about 50 as the line. ASIC Money Smart guidance and retail quotes suggest that if you're healthy and under roughly 50, a retail policy for the same sum insured often isn't dramatically more expensive than group cover, especially once you count the compounding you lose to inside super premiums, which can reach around $26,000 by retirement on just $400 a year. So if you're under 50 and healthy, outside super cover is very affordable and worth loading up on. If you're older or you've got health issues that make underwriting hard, the guaranteed acceptance and tax efficiency of inside super carry far more weight for you. Your age is the swing factor, and that's what makes the final call clear. So which one wins for you? Honestly, it depends, but not in a wishy-washy way, because there's a clear rule. If you're young, healthy, single, and on a tight budget, keep your baseline life and TPD inside super, fund it with cheap 15% tax dollars, and move on. If you've got dependents, a mortgage, or a real need for adequate cover, keep a baseline inside super, then add top-up TPD and life outside super, where APRA and ASIC's 2023 data show payouts averaging $643,000 and $509,000, and where MetLife confirms benefits are generally tax-free and paid directly. And if you've got health conditions that make retail underwriting hard, lean more heavily on the inside super cover you can actually get. The losing move for almost everyone is the same: accepting the default and assuming $143,000 of TPD is enough, because it usually leaves a $500,000 hole. Here's your decision guide. Choose inside super if you're young, healthy, budget constrained, or hard to underwrite, and you only need baseline cover. Choose outside super if you've got dependents, debt, want tax-free payouts paid directly, or need trauma cover super can't offer. And choose the blend, which suits most working families, by keeping cheap baseline life and TPD inside super, then adding outside super top-ups to reach an adequate sum, insured, generally tax-free per MetLife. Whatever you pick, log into your fund today, find the Insurance tab, and read your actual cover amounts and premiums in real dollars. And if you salary sacrifice to fund extra premiums, check your concessional contributions cap with the ATO first, so you don't accidentally breach it. If you've made it this far, you now know something most people with insurance in their super simply don't. It isn't free, and the default amount is almost never enough. Your one action today takes 10 minutes. Log into your fund, find your life, TPD and income protection figures, and ask yourself honestly whether $143,000 of average TPD cover would really protect the people who depend on you. If it wouldn't, that's your signal to look at a top-up outside super. Remember, this is general information only, not financial advice. Super rules and thresholds change, so check with a licensed advisor or the ATO before you make a move. If you want to go deeper on getting your cover right, that's exactly what we cover next. I'm Alex, I'll see you there.